we're still not at the top as I see it, and we haven't had the big blow off top yet. So obviously we will not see a recession here by June or August or anything like that, but I still think we're going to see it by end of this year, and the market top is most likely to be in let's say September, maybe October of this year. Also, when it comes to to a recession, there are so many indications that the labor market is deteriorating, and this is the real economy. The labor market and the housing market, the housing market has already deteriorated, and we see how a lot of the index there are down, significantly, and I think they'll take another tumble. So the consumer is struggling right now, and that is what is going to bring the economy into a recession.
Hello and welcome back to Soar Financially, where we discuss the macro to understand the micro. My name is Kai Hoffman. I'm the JR Mining Guy on Twitter, and of course, your host for this conversation. Really looking forward to welcoming back Henrik Zeberg. He's the head of macro at Swissblocks and also co-founder of the Zeberg Report. He's a frequent guest here on the channel. We have him on about every 4 to 5 months to keep track on what he's forecasting, where we're standing on the blow-off top, and how are the markets doing in general. Really appreciate his the conversations with him, so we always appreciate him taking the time to come back. Lots to recap. Lots has happened since January. Last we chatted, the market expected almost 6 to 7 rate cuts, and now we're down to 1, maybe 2. So we're going to recap his forecast as well, and to see where we're at on the economy. Like, how's the U.S. consumer doing? And we also discussed that we're going to talk about a little bit about the EU. How's the European consumer doing? What's the monetary divergence, or what do we call it? The monetary policy divergence look like, and what does it cause? Like, why has the EU lowered interest rates and the US hasn't, for example? So we're going to take a look at that and contrast the both, or the two of them. So before I switch over to my guest, you guys know the spiel. There's somewhere down there is a subscribe button. We tremendously appreciate if you were to hit that, because we can bring guests like Henrik on more frequently and invite other phenomenal guests as well. So it is much appreciated. Now, without much further ado, Henrik, it is great to see you again. Thank you so much for making the time.
Thank you for having me back on again.
Yeah, I can't wait. Like, I'm really looking forward to the next 40 minutes here, Henrik, because we got so much to chew through, and some calls to sort of discuss that you made in January, like recession call, for example, is the big one, of course, that everybody has been talking about. But why don't we start with a bit of a summary first and try to understand, like, how is the economy doing? Maybe the U.S. economy and then global economy.
Okay, so I have to say, the U.S. and is driving the global economy. So even though we would like to think that we matter a whole lot here in Europe, we actually, when it comes to the financial markets and it comes to the economy, it's really about the U.S. So if the U.S. is well, then the rest of the world is also kind of good. But and you'll probably never see a situation, or not for the next many years, where Europe will be the one that is powering through, and then the U.S. will be the one that is lagging behind. So I think it is about the US very often. But of course, there is a big area here also called EU and Asia and elsewhere. So we need to discuss that as well. Um, and I think, you said, how are things doing? Sorry about that, Kai. I just need to pick back on this. But so, yeah, what I think, yeah, well, I had a recession call that I called there in January, and I still stick to that. We're here in July, early July, and we start to see some of the fallouts of that, of the deterioration that I was expecting. As I said back then, I'm pretty sure I said, we have the business cycle that is slowly turning over. We have the leading indicators that have been telling us for some time that a recession will be coming. Then we have had this spike in the markets that I also think I called for, the S&P moving up. I think it was was it 1,000 points in the S&P since January. We're still not at the top as I see it, and we haven't had the big blow off top yet. So obviously we will not see a recession here by June or August or anything like that, but I still think we're going to see it by end of this year, and the market top is most likely to be in let's say September, maybe October of this year. So there's not many changes, but yes, as you said, also there's we've postponed the thing because the economy has been stronger. The labor market has been more resilient than I expected back then. But that is just the name of the game. Sometimes it's about being on the right side of the fence, right side of the trade, and being long the market and risk on has been right for now. I think still is, and for a little while longer. And we will then eventually see that the deterioration that we now see also with the most recent numbers coming into the economy, that is just normal. That is what I expected. That is exactly what the coincident indicators should be doing now, as the leading indicators have been telling us. So no changes, but small postponement. Yep. So the PMI numbers are not leading indicators in my model. The PMI numbers are something that is other business cycle analysts are using, but they are not leading indicators in my models. But anyway, the coincident indicators. What I see there is the deterioration that we saw from the leading indicators will spill over into the coincident indicators. So what we have seen for so long is a labor market that has been stubbornly strong, and you can understand why. So into the Corona crisis and after the stimulus came out, a lot of businesses around the world were doing really well. People, any business were just seeing their numbers going up because stimulus coming in brings demand in, brings a lot of consumption also in, and that's why businesses will do well, whatever kind of business you're in. So we saw also an extraordinary demand for labor and buildup of capacity in across the board and across all businesses around the world. And of course, when you build out that extra capacity, it will take a little while before you, as a business, say, "Oh, we were actually wrong in bringing those 20 extra people in, or whatever it was. We need to lay those positions off again." So what they first do is that the spike we also saw in open positions around in the U.S. market again. Well, we actually seen that come down really strongly. So the open positions are coming down strongly and are now down to levels that we saw just around the outbreak of the Corona crisis, and with that short recession we had there. So that is coming down. That is the first thing that the businesses will cut. The next thing that will then start to cut is how many hours do we need people to work, and try to adjust that to make sure they don't need to lay people off. And then later on, you're going to see the layoffs. So I think we're starting to see that next wave here now, that we're going to see the layoffs coming in, because that's the next thing. And if you look at the corporate profit numbers that came out, I think it's a couple of weeks ago, they were not fantastic, absolutely not. And that is telling us that the consumption is not there, the demand is not there, and this is because of the consumer. Back to the consumer, which have now been using the excessive savings that they have seen, or they have been building up over since the Corona crisis, and now they are starting to cut spending, and this is what brings the economy into a recession. And nothing new there. There's nothing new under the sun here. It's really what we've seen so many times before. It's just because it lasted a little longer because of this extreme spike we saw in because of the major stimulus we got after the Corona crisis.
All right, pardon the interruption. We've got inflation and interest rates likely sticking around for the summer, at least. So I want to talk about this article from Goldman Sachs that's aged like fine wine. It was published almost exactly 2 years ago, when inflation really started cutting through our earnings. Goldman focuses this piece entirely on real assets and protecting your purchasing power, with special emphasis on gold. And in the same sentence, where they specifically name precious metals, Goldman brings up another exciting real asset: fine art. It may sound surprising until you consider the billionaires who sit on 9-figure plus art collections, like Microsoft co-founder Paul Allen or hedge fund billionaires Steve Cohen and Ken Griffin. In fact, the overall art and collectibles asset class is estimated at nearly $2.2 trillion by Deloitte, and is expected to hit almost $2.9 trillion in 2026, leaving lots of room for potential upside. That's why you should check out today's sponsor, Masterworks. While you're still early to the scene, their art investing platform has already distributed back a total of over $60 million in investor proceeds across 23 exits. And you don't need to be an art expert to get involved. You also don't need to throw in millions of dollars, and can diversify between multiple paintings. Because Masterworks' art investing platform offers blue chip paintings to investors in the form of shares. Some of Masterworks' previous offerings include legendary artists like Picasso, Basquiat, and Banksy. And they're nearing over $1 billion of invested capital, so offerings have the potential to sell out rather quickly. So if you're interested in learning more and want priority access, you can use QR code on the screen now, or use the link in my description below. Past sales and previous offering demand are not indicative of future results, and all investing, of course, involves risk. See important Regulation A disclosures at masterworks.com/cd. Now, let's get on with the interview. Yeah, it's interesting. Let's break down the consumer a little bit. I want to talk about it a little more. It's vitally important in the US, which is a service-based economy. So if the consumer is doing well, the economy is typically doing quite well. But again, we're getting mixed signals, like household debt is rising, for example, right? And they're a bit more cautious on spending. They're substituting. They might be buying the cheaper pork sausage instead of the all beef Frank sausages for their hot dogs, for example. Can you break the consumer down a little bit and like sort of explain like where the fears are coming from and why we should be paying attention to the consumer so much?
I think this is breaking it way down too much because there's really just about two things when it comes to the consumer. This is about the housing market and it's about the labor market. If we think about ourselves, we got a job. For as long as we got a job, we're happy because then we got we got an income. But we also, if we look at the housing market, if our houses move up in price, well, we feel that we are better off, and then we'll probably also be more prone to spend more. But the thing is that we've seen because of the interest rate spike that we saw because of the inflation coming up, we've seen now the consumers getting hit on the personal interest payments, and that move we have seen in that has been the strongest that we have seen in the last 70 years, or for as long as I have data anyway. And if that is really what is causing the concern here. So what the first happens is that the consumer has their whatever kind of debt on loans they have, across their economy there, and then they will start to see that they have to spend more money on interest payments. And you don't go sell your house first, and you cannot just pay down the debt you have on your car or whatever it is. So you will have to cut spending elsewhere, and that is the slow deterioration that happens. This is the business cycle. This is how it works. So every time we see that the interest rates come up, we actually, and especially when they come up as fast as they have done this time, what the consumer will do, and we can just think like you and I here, what we will do then is that we'll use some of the savings we have to make sure we don't have to sell the house. And then at some point we'll start to say, okay, we need to do something extra because things are not good. They are not turning, we still have to pay this, extreme amount in interest payments. And that level has not come down yet. So the consumer is struggling right now. And if you start to look at the credit card delinquencies what we normally look at as well, you see that actually, if you look at a rate of change, you'll actually see that these are coming up faster or as fast as we saw into the financial crisis. Wonder why? Well, the consumer is spending all their money on interest payments. So yes, consumption will be the next thing, and the next thing again will also be that the labor market will see a clear deterioration. And I think we're starting to see that the initial claims are now creeping up. They are a little higher, not high as they supposed to be before recession, but it's if you get there are certain indicators that you can look at. There's one that's called the Sandler Piper indicator, which is already triggered also when it comes to a recession. There are so many indications that the labor market is deteriorating, and this is the real economy. The labor market and the housing market. The housing market has already deteriorated, and we see how a lot of the index there are down, significantly, and I think they'll take another tumble. So the consumer is struggling right now, and that is what is going to bring the economy into a recession. And will be like jumping on ice. I mean, you don't fall through until the moment you fall through. And that's the problem. When you get wet, you'll get wet and you'll get very cold. So I think this is what we're going to see this time around again, and we are very close to that moment. That that's what we always experience when we see a recession. It may, when you ask, ordinary people they will say, well, what was the cause of the financial crisis? It was the collapse of the Lehman Brothers. It was not. It was 9 months into the recession, so it was not. It was the slow deterioration of the economy. Now you call it the death of the thousand cuts. I mean, this is what we see all the time. The thousand cuts is what we see on the consumer. They are getting hurt by the interest rates payments, and then you slowly start to see that seeping through into the economy, into everything that they do, and then all of a sudden you'll see that things are just getting to the point where the businesses will start laying off people, and this is the point we're getting to. So far, the consumers have been able to keep their spending up, even though retail sales numbers are not great, but I think they'll become even worse soon. And then you'll see that the businesses will also start to see, that they need to cut their workforce because they have to adjust accordingly. This is the point where we'll start to see the layoffs. This is the point where it really starts to become a problem in the economy. And if you look at it, again, if you look at it from a cyclical perspective, we have exactly the same kind of development we had into the financial crisis. I mean, there's so many similarities. It's just as extraordinary that nobody actually sees it. But now, yes, the PMI numbers, which is the ISM numbers that we saw yesterday coming out there, well, they were not great, and this is expected as according to my model.
Yeah. Maybe last question on the consumer, and I wrote down the buzzword is bubble behavior. And one headline that really fits the bill here is a CNBC headline, like 36% of Americans plan to take on debt for summer travel. Okay. So I'm curious, are they still expecting to be bailed out once doo-doo hits the fan here? Like that bubble behavior, I'm curious, where do you put that? Or do we see bubble behavior like that?
I'm not sure we see bubble behavior in spending. And again, I think, we have to go down to the ordinary Mr. Jensen here in Denmark, that, what is it that he or she can do in terms of, with the money they have at hand. And of course, people will be looking into say, okay, we really need this. So we'll try to take a loan out to see if we can, to have that kind of, or do that kind of, spending, or have that kind of spending. But I think the bubble behavior is more on the financial market, and I think there will also be a disconnect between what we see in the financial market and the kind of expectations there, in terms of now the Fed is finally coming in and starting will help us, and save the day, and they will bring about a lot of liquidity. So I think that kind of behavior is more on the financial market. I think the ordinary consumer in the US, in Denmark, in Europe is struggling, and they are that because of very concrete reasons. They are paying a lot of money in interest rates right now on an average basis. I know that there are people that have different kinds of loan, but if you look at the loan, the debt levels now are so much higher than they were in 2008, and now we have the interest rates up at those levels again. If that was a problem back then, I'm surprised to see why people can't understand that debt is a problem these days again as well. So some people may want to say, well, we'll take out another loan here, but and again, interest rates will also be dropping into the recession, so maybe it'll be easier for them to pay it off. But chances are, or a risk is that we will see a lot of people losing their jobs as well.
So Henrik, for some reason, I've been watching The Big Short every 3 months, and there's always somebody who's winning, like the mortgage brokers who are bragging. All right, in the movie. So who's winning right now? Like, if you have a look at the markets, it seems quite bifurcated. But who are the winners in this time around?
So until now, it's been the ones that have been risk on. I mean, risk on since October 22 has been good, and I've been there. And I think we will see that for some more months. We'll see that the pure risk on assets will be the ones that will doing well. And we are sitting here today and talking while Bitcoin is in a plunge, and I still see Bitcoin at 110,000. So I'm not too worried about what we see right now here. I think Bitcoin, cryptos, and also small caps will have a fantastic rally here into the moment of when the recession hits. And I think we're very close to the moment where the Fed is at least going to start talking about a cut. I don't think necessarily they'll cut here in July. We have the next FOMC meeting in September. I think probably that would be the first month of cutting. And normally we see that the market tops out around that moment. So the market top in September or in October could be the case. And that means that until then, it's risk on. And I think, for a lot of assets, and we are nowhere near the animal spirit that I'm expecting. So I think we will get, a lot of that into the coming top. So these are the winners for now, but they will definitely not be the winners in the next phase.
A market usually takes or front runs sort of its predictions. It prices things in. Like how much is a rate cut already priced in September? When you say that the top is going to hit in September with the rate cut in September, like isn't there usually a bit of a, what do you call it, like a time gap, right, where the market starts to anticipate, front runs a decision, and then it gets, when it actually happens, usually the market drops. Is that sort of what you're predicting there?
I don't like this about that everything is about what the Fed does, because if you look at it, you'll actually see that when the market when the interest rates are going up and the Fed is hiking rates, these are the times when you have the largest rallies in the market. So I don't really buy into this. When the Fed starts to hike, when the Fed starts to cut rates, that is a moment when the economy is starting to deteriorate, and that is a time where you also want to get out of markets. The time you want to be in a market, the time you want to be long risk asset, is when the Fed is, seeing the economy and thinking, okay, we need to maybe, hike rates, or maybe stay, neutral here, or stay flat, because then they're, the markets know what to deal with, and they will be, and the economy is doing well. But this is what should be in focus. This about that, it's only about liquidity all the time. There's a certain part of the cycle where it is about liquidity, but by the end of the day, it's about the business cycle, it's about the real economy. And so how much the market is, anticipating in terms of the rate cut. I think that the expectation of liquidity is starting to build in the markets, because obviously, also with the numbers that we saw yesterday on the ISM numbers, we will start to have, people start to understand that, of course, the Fed is not going to hike again. I mean, that would be stupid, just, pure stupidity, and, kind of never say that will not happen. But anyway, and also that I think the dollar is going to come down very strongly. So into this, when we start to see the weaker data in the economies, and that means that you have a certain time where it's all about liquidity, and you'll have these people, liquiditists as I call them, that think that the business cycle are driven by liquidity, and that's why we should see the market just keep going up, and a lot of these people will be, running into the markets, and so there are different dynamics here as I see it. But in the general terms, I like to be in the market when the Fed actually, when they hike the rates. And for now, it seems like the closer we get to the point where they want to, cut the rates, the more, concerned I will be about being in along the markets.
Your Danish colleagues at Saxo Bank put out a Q3 report, and they use the term sandcastle economics. I really like that term because it really symbolizes that everything is quite fragile. Like the whole current economic boom, and that's a strong word, that we're witnessing in the U.S. in particular right now is extremely fragile. It's driven by excessive fiscal policies, and only very few sectors are benefiting, like AI, obesity drugs, and maybe semiconductors and defense, because the world we're in. But you look at liquidity, is like once one of these sectors starts to crumble, and maybe AI is in a bubble. If you look at 48 times earnings for Nvidia, as a valuation metric, for example, like what happens? Like, what's the trigger? I'm trying to figure out. Like, I'm trying to get a sense. Like, what comes first? Like, is the Fed the trigger? Is the economy the trigger? We're at the end of Q2 now. We're going to see some numbers potentially come out in the next few weeks. Some financial numbers from the companies. Like, what's going to trigger it first? And curious what your thoughts are.
So it's never a one moment kind of thing that triggers everything, and then boom, it all collapses. It's about when the economy has been deteriorating, when meaning the consumer has been struggling for quite some time, and they simply do not, the demand is simply not there any longer, and it starts to come down. Well, then the companies have to simply cut the number of people that they have employed. So this is it's a super tanker turning. It's not a speedboat, and then all of a sudden it's like boom. Then it just turns around, and we have the really bad economy. We have an economy here that is late stage in the business cycle, where we see that the Fed will now start to think about cutting rates, and they do that because the economy is deteriorating. So sandcastle economy, I don't think it is. I think yeah, sandcastle. It is a sandcastle that 100% is going to come down, and it's going to crash. I see there's no way out of this situation we have at this point here, where we're not going to see a recession. I simply cannot envision that or see that. And that means also that a lot of the things that we have seen in terms of the moves up, and now you're talking about Nvidia and others, are clear bubble, moves that we see. And yes, AI is in a bubble and will be for a little longer. And as I said, I don't think I've seen the real animal spirit yet. I had a great episode of the last animal spirit back in 21 when I talked to some young guy at a cafe, and he was from a very wealthy family, and he kind of told me what the non-fungible tokens were all about and why I didn't understand that and why it would be the next thing. We're not there yet. We don't have that, and we don't have all the Lambo guys out yet just yet. We will get there because the crypto market will absolutely develop into to these kinds of this kind of spirit will come out of that if the move higher that I expect is developing or will develop. So what we will see will be a slow deterioration, and even when the top is in the market, nobody will actually tell us this is the top. And then we'll see it bounce back up again, and people will say, "Oh, now you see we're going back again." And then it'll first be at the moment where the blow, but we really start to see the deterioration. And we have to think back to let's just to do a history or a walk down history lane here, memory lane. If you look at 2007, you actually had the recession beginning in December of 2007. The stock market top was in October of 2007, 2 months before. This is how much the stock market to kind of predicts, let's say, the economy, the turn in the economy. So like 2 months worth. But what happened was that nobody really understood that was the moment that the stock market had turned it to in October of 2007. And actually, you had Bernanke coming out in January, February, and March, even I think, saying, "Oh, we got some issues at hand here, but we don't see any recession." And we were in a recession at that point. That started in December 2007 already. So people do not really see it before it actually starts to get bad. Then you had in March of 2008, you had the first kind of fallouts from the financial crisis that we're developing at that point. And again, it does that slowly. It's not something that just boom is there. And you had the Bear Stearns situation, and everywhere else in the financial sectors, things were just deteriorating because the consumer were not well. This is what I think we'll see again. And I think we'll have another financial crisis this time around. So we will not see it just like, which day is it? Boom, there we go. It'll be a top in the market, let's say September, let's say October. There'll be a recession beginning in December. Nobody will know about that. We'll see the first decline into the markets, maybe into the early of 25. That was actually the top in late 24, but in 25 we'll even see a bounce into the first few months, maybe not to a new all-time high, but just another bounce. And then maybe as we get later into 25, we'll start to see the real deterioration. That is how it turns. It's not a boom. So we should not wait and sit for that. Sit and wait for this the bell kind of ringing at the top, and then somebody will say, okay, now it's there. I will try to do it on Twitter, but you can wait for my bell. But I think you will not see that in the mainstream media and the mainstream and amongst the mainstream analysts.
But you would think like fear mongering usually works quite well, even on mainstream media. It usually brings the clicks and the views. So surprised they haven't started ringing the bell just yet. And maybe we'll see a bit more because liquidity is a topic you mentioned, and the U.S. is spending like a drunken sailor. Like the monetary deficit is exploding. It's like $2 trillion a year right now because the U.S. has to spend. Like defense, I mentioned earlier, is a big topic that's benefiting. The U.S. is in the middle of almost like a three-front war, it seems like right now. So when the U.S. turns the tap off, is that also a signal, or can or maybe the wrong way to approach this is like, will the U.S. turn the tap off? Like, is that, or will it be forced to turn the tap off at some point? I'm curious what your thoughts are in the U.S. debt situation. Is the short summary of my long question.
Sure, got that. But obviously, there is an issue there. There is an overspending issue, and there is an issue with that. If the U.S. at some point does not get their acts together and start understanding that they do not have a divine economy, and that they need to match what the taxes and what they and what they spend, at some point it will become a problem. Will it become a problem right now? I don't think so. And actually, you have even though the death of the US dollar has been forecasted or been expected so many times, we don't see that. We have a very strong dollar, and that is because there is just one currency to rule them all, and that's the US dollar, which is also the case right now. And the very strange situation here is actually if the US turns off the tap, so to speak, and does not have that kind of deficit that they have right now, well, then the rest of the world will actually be starving in terms of US dollars. So there is a need for the US actually to keep that spending, to keep pushing a lot of dollars out there. And if they don't, well, then the rest of the world will see a problem. So I think this is actually the very foundation of a larger problem, a monetary problem that we see, and that we will be need to be fixed at some point, and will need to see to get sound money back in, which will be part of a monetary reset that I think will come not into a deflationary crash, because what they will do there is simply just to do even more monetary printing, and they will do that. But I think the next phase that I expect we could see would be a stagflationary phase, which would be like in a year and a half, 2 years from now, which could then you know dramatically change the whole setup, where pouring more money on the system into the system will be a big problem, and it will cause more inflation. So I think um, it's not it is a problem. It's a fundamental problem. It's a fundamental problem that needs to be solved, but it's actually something that right now is not being felt as a problem because the dollar is so strong and the rest of the world needs this, but will become a problem the moment when we start to see an inflationary pressure building up. And that is also the moment when I think with there other tools will be needed. This about having a free lunch and just pouring money, print the money and we'll send it into the system, is something we'll look back at and say, wow, what were we thinking? What were we thinking? We thought we were living in a new world, in a new regime, and so on. But when everything comes down to it, we were just living in a good old world in terms of how things are working in the economy. And but for now it will work, and it will probably be also the tool that they will turn to when things are turning bad in terms of the deflationary bust that I expect into the last part of this year, or let's say when it starts to be felt will be 25.
So, Henrik, like one topic that we often discuss here on the channel is the debt to GDP ratio. The US, I've been looking at it, is right around 120. Over the last 3 years, that number hasn't really changed. It's 120, 122, a little bit of change here and there, but not a big change. Now the CBO comes out, the Congressional Budget Office, and forecasts a debt to GDP ratio of 140, and nobody bats an eyelid. The question is, like, why does nobody care? No, not the presidential candidates, not the investor. Nobody. Like, there's no Main Street headline about that. And are they not worried that the debt is going to get called it someday?
Well, everybody's called. There's a problem since I don't know, since 2008, and now we're here 16 years later, and it's not a problem. So why would it become a problem right now? And it's simply just not a good thing to call. Is it wrong that it's not a problem? No, it's not. It is a problem. It's big, absolutely a problem, and it's something that will also they will have to solve at some point. But that is left for some other day. But if you start to talk about that right now, and it's simply not just a winning point, I think, because everybody would just point and say, yeah, yeah, we said that for the last 16 years, so, and it hasn't been a problem so far. And by the way, we owe the money to the Fed, or to how is it that it works actually? And there was this guy coming on who actually couldn't explain how it all works, and how the whole cycle of money there. So I think it's simply just too big to understand for people to say, yeah, it's just, and these are new times. I don't know, Kai, why people do not take this seriously, but it is a problem. Absolutely, it is a problem. Of course, we have the strongest reserve currency that we have ever seen. We have a lot of demand for it, which is what we need, and it's never a problem for as long as that it's strong, because then you can just print the money, and nobody really cares. The problem will be the moment when inflation starts to tick up. And I think this is what people really do not understand. In a deflationary environment where the pressure is so strong, it's not a problem. Yet then people say, yeah, but we have had inflation. No, you had inflation because of a spike in demand at the time where you had a supply crisis. That was not inflation. But if you start to see structural inflation coming up, well, then it'll be a completely different matter. And that is what I think will be the next phase, where then this whole thing will need to be taken up. But for now, I don't think it's something people want to point to say, well, this is a problem, because they just, everybody just point to and say, why do we want to care about it? Because everybody's been pointing to it as a problem for the last 16 years, and it never has been a problem.
So, Henry, I think we've painted a really holistic picture of where the economy is going. Let's see how other asset classes are going to behave once we hit that recession, starting maybe in Q4 or early Q1 2025. And mainly, I'm thinking about the US dollar, but also precious metals. Let's start maybe with the US dollar. Like, how's the US dollar going to behave going into that recession? You mentioned King dollar is super strong, but what will it weaken?
I think it weakens from now on. I think we have seen actually we saw the top in October of 23. Actually 22 first. We had a first decline, then we had a bounce, which was came into 23. Then we saw a decline, and we saw another bounce into to April. But I think from now on, I actually think from this moment on here, we're going to see a very strong decline in the dollar down to around 95, 93 before we see the recession sets in. And this could actually again mirror somewhat what we saw into the financial crisis. Because if you look at the financial crisis, we saw the dollar was actually weakening into the top in the market there in October. Then we saw a small bounce, the recession began, and then we saw a weakening of the dollar into March of 2008, where then the real shit hits the fan, or hit the fan at that time, which means that the deflationary pressure starts to show. Again, we have to understand that this is where the slow deterioration of the economy comes into the financial markets, into the banks, and so on, and they start to have problems, and there start to be a shortage of the dollars. I think this time around will be even worse than that. So I think the dollar now will drop down to around, as I said, 93, 95 ish area, and that will really power the blow off top, and then we will see a bounce, not just a bounce, but a strong rally into the deflationary part of this crisis, which means that we should see a dollar going up to 120 on the DEUTSCHE going to 120. That will not be a pleasant situation, and this is where the Fed will come back in again. So I mean, I think I see the levels that we could get to, and then also why, in terms of the deflation, and also when the Fed will start to try to counter what they see in the dollar, because the strong dollar will kill the economy.
Strong US dollar, or weaker US dollar, sorry, is like if it goes to 92, 93, should mean that gold is going to explode even higher than it is right now. We're trading at 23.50, 23.60 right now as we speak. So, like, given that factoid, like, let's talk about the gold price behavior. Where do you see gold going in the interim or in the short term before the DEUTSCHE explodes to 120, which should mean that gold probably completely implodes?
Yeah, but I'm not too sure that gold will actually do well in this environment here. Still, I mean, I'm actually quite certain that it'll, as I said, also implode, and as you said, also implode in when it goes to 120. But I'm not certain that we got so much time left for gold. I still say, well, it could reach 2700, but there is also good risk that we actually did see the top already in gold, and that we're starting to see that decline that could bring us down to at least maybe even 1200, 1250, as I think we could see. I think there is a big decline coming because of the very strong deflationary bust that I see. And again, we also have to remember how gold did from, let's say, the moment when we saw the dollar also starting to rally into the financial crisis, which was from March of 2008 until they kicked off QE. Well, you saw a decline of 34% in gold, and you saw a decline of silver of 60% in that 6 month period. This is what I'm talking about when I'm talking about the big deflationary bust, because you don't want to hold, when liquidity becomes a problem, you don't want to hold gold. You hold something that, is required to pay your debt off. So again, I'm not sure we're going to get it, because also, there's not 100% correlation between gold and the DEUTSCHE, or inverted correlation between gold and the dollar. So we need to be careful here at this point, because there's the beginning of you know of an environment here which will not be beneficial for gold. But of course, the dollar going lower will be somewhat of support for gold. And but again, I also just think there will be other better places to be, which would be, for instance, Bitcoin, and for risk asset, which is may sound strange into a crisis, but you often see these blow off tops and right into the moment where the market turns and really strongly against the other direction. So I will be careful. I mean, why something which we know will probably get hit hard at this point? And again, I don't see palladium, I don't see platinum, I don't see silver, I don't see gold miners having followed gold on this path higher. I've seen them underperform all of these versus gold. So I think gold is the outlier. And whether it takes another move to 2700 before we move down, or it drops from here, I think it'll be speculative, but I think it's not the environment to be long gold. Before, again, as I said, I can be wrong with up to 2,700, I think.
Curious, like, and have the fundamentals for gold changed? Like, if you look at it, like, that's why gold may be ripped. Like, we've been interviewing guests, and they said, well, it's Chinese buyers, Chinese retail buying now, because they're in German, the word is concrete gold, like has disappeared, right? They can't invest that anymore. The housing market or real estate market in China has imploded there. So they're looking for an alternative, which is gold. Do you think the fundamentals have changed that would sort of trigger maybe a shift in thinking and maybe in the prognosis there as well?
Short answer, no. These are the kind of narratives that we also always hear. Then when things are starting to move in that direction, and then we have all these alternative explanations why things are going that direction. Then they will end up why then does it all of a sudden change in the opposite that goes in the opposite direction. So if I'm right on that we could get a dollar that's spiking to 120, I can promise you gold will not do well. And again, I'm also looking at an outlier here. I'm looking at gold, which is the outlier compared to everybody, to all the other precious metals we got, and to even to gold miners. Why do we see that? Do we see that because maybe the whole narrative has spoken gold into or brought gold into a kind of a bubbly situation at this point? I think that's more likely than that we have seen a shift in some kind of narrative or some kind of fundamentals here. But that is the normal narrative. That is what we always hear. This is because, and Henrik, you need to understand that blah blah blah. This is, I think it's gold will have its time, and I'll be massively bullish gold, just not yet.
$6 trillion are sitting in money market funds right now. And as soon as the Fed starts lowering rates, I don't think it's going to be 25 basis points, but at some point, that money is starting to move and a cycle back into maybe the economy or other sectors where it can actually achieve a yield. Where do you think that money is going to go?
Well, I think we again depending on where we are when we talk about this, when it will happen, I think we will see that the risk asset, a lot of risk asset will move a lot higher. I think the FANG stocks will still have a good place, good to move, and you'll see that is where a lot of this money will go for a certain amount of time into risk assets. That's what I'm trying to say. So into the equity markets, and that will then funnel itself into crypto and else. So a lot of this, the money that is sitting on the sidelines, that will find its way into that for a certain amount of time. But then I think also we'll start to see that the bonds will do better. I think we're getting closer to the moment where people say, okay, maybe we should take some risk off the table, maybe bonds at these levels, and it's actually quite nice to get a nice return there, a yearly return on dividend. So I think there will be a time where people will take some of the riskier money off the table and then put it into what to U.S. bonds especially, and I think that will rightly so, and that will also drive a lot of the decline in the interest rates that I see is coming into this crisis.
Summary question, Henrik, and I like that one as a summary question, is if you were to invest $100,000 today, how would you allocate that money?
Right now, I'll put it right into Bitcoin. Right now, I'll probably put 50% into Bitcoin at this point here. I think Bitcoin has 110,000 target, and then I would do some more on maybe also the smaller cryptos. I think we will have as I said, the animal spirit will be crazy, and then I will save some cash as well. Also, a little maybe 10-20% of it I'll have just to see if there's any good opportunities popping up here into the final. But I'll be very aware that we only have a timeline until September or October, and that's the timeline I look into now. And of course, I will reevaluate if we get to that and we don't see 6,100, 6,200 that I have as the S&P target. If we haven't reached that at that point, well, then we will not. Then I may wait another month with take my money out. But I will be taking a lot of money off the table at the point, or a lot of bringing my risky positions down, significantly at the point of in time, maybe in the September, October.
Fantastic. Henrik, always appreciate our conversations. Always really lively, always engaging, and usually really good back and forth. So always tremendously appreciated. But where can our viewers follow you and get more details?
Well, I think it's the best way to find me is simply to get on Twitter and find me at Henrik Zeberg, and then there will be links to where to find me there on Twitter. Or an X, it's called. Sorry, X. I'm just so old. I just call it Twitter all the time. X. Yeah. Sorry about that.
I'm old enough to remember it was called Twitter. So
Exactly.
No, fantastic. I really, really appreciate your time, Henrik, and can't wait to catch up with you again in the next 3 to 4 months. Again, we'll schedule that. Maybe we're going to see each other in Germany as well. You're going to be a keynote speaker at our DEUTSCHE GOLDMESSE in November, but I'm sure we'll chat before then because we have the U.S. election coming up as well. Didn't get a chance to talk about that because I think we need to figure out who's the U.S. presidential candidate for the Democratic Party first before we make any assumptions.
Yeah, absolutely.
So fantastic. Awesome. Henrik, thank you so much. And to everybody else, really appreciate you tuning in. Thank you so much for watching. If you have any questions, any comments, please put them down below. Constructive feedback is always welcome. We do want to hear from you. And where do you think things are going? It looks like we're already in the middle of a blow-off rally because we had Henrik on in January this year. The market was trading about 4,500 points on the S&P. We're now at 5,500 points, another 1,000 points higher. We're in the middle of it, I think. So question is, when do we start ringing the alarm bell, as Henrik said? And so keep a lookout for that and to follow us and other channels as well to get educated. Make sure you're smart, you're positioned, and to be ready. Thank you so much for tuning in. We'll be back with lots more here on Soar Financially.